All right, let's get going. This is a sad song, huh? All right. Goodbye, Mr. Beethoven. Yeah, he wrote that song completely deaf. That's the sad thing about that song. He wrote it with one ear to the piano. So if you find that song somber, yeah, imagine being a musical genius that's deaf. Yeah. Anyways, hey, good morning. How are you? Welcome to QuantBox Live, your hour of power. Let me bring it up. QuantBox.co, where you uncover the best fundamental investment opportunities across global markets through AI-driven analysis of sentiment, inflation, employment, GDP, technical trends, open trade positioning of both institutional and retail investors, and seasonality and market sentiment by analyzing things like new things and new features that we analyze the VIX and yen futures and dollar futures and the S&P 500 and gold and the yield on the 10-year T-note to develop market biases. Market, not necessarily fundamental. On short, medium, and long term, just like ridiculous, amazingly important information, all available for you at QuantBox. My name is Wayne McDonald. I'm the founder. I'm also a Harvard-educated economist. That's why I love all this stuff, because I study it. I actually do the math. Yeah, very cool. And so we analyze global macro trends and do comparative analysis. We then break it down to individual assets and their fundamentals. We track, like I said, institutional investors. By the way, this beautiful thing, that's the Commitment of Traders report. Yeah, pretty. You can break things down: GDP, inflation, do comparative analysis amongst other countries, and a whole bunch more stuff, so that you know why you want to make a trade, not just that something appeared. Okay, you never want to invest simply because your MACD told you so. Well, your MACD isn't intelligent. So anyways, hey, if you're watching this on YouTube, swing on by quantbox.co. If you have $8 in your net worth, maybe you want to use it for a 1-week trial and be amazed. Be ready to be amazed. There's 10 million times more benefits in the annual. And you're like, if you actually do the math, you're like, wait, annual gives you so much more, and it's actually cheaper. Yeah, and by the way, the list got even longer. I just haven't updated it. So, trust me, you want this, it's good for you. Anyways, swing on by, YouTubers. And by the way, YouTubers, it's 6:30 in the morning right now. You're watching this at 10:30 in the morning. So if you like what we're doing, it was already done. Okay. So kick down, come clean, don't be a holdout machine. All right. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus in the long term. Never risk money you cannot afford to lose. Loggy in. Let's log in in. What do you think of the median minutes? Oh, is that right? All right, cool. Yield on the 10-year T-note. Oh my God. Holy smokes. This was even higher earlier today. It's amazing. Yields are going cray-cray. The yield on the 2 years about 5%. I think it was 4.96 the last I looked. And 10 years approaching that. Kind of interesting. The yield curve is verting, whatever the reverse of inversing. Cool. I guess something's definitely happening there. Okay. Oil is stabilizing. It was way down, but it's stabilizing now. Probably an interesting opportunity for buying. Gold was down at 19 and held. Remember, our target was 1891.36. We actually touched it. Now, I don't know if that's the actual price. Probably not. There's been a glitch in the matrix. But we'll end up taking a look at gold. Anyways, S&P 500 stabilizing at 4,400. I might be a buyer. I'll remind you, I won't be here tomorrow. I'll be in Cuba. And I'm terribly, terribly FOMO, only because I'm not going to be at my desk. And I fear somebody out there is controlling the market and laughing at me. I don't know who it is, probably a powerful godlike creature. But as soon as I go to Cuba and there's no internet, this thing's going to rally like a son of a gun, and I won't be able to trade it. So I don't know how to handle it, but I might be buying the S&P 500. I don't know. I'll give you an example. I was in Canada with my wife, my two children, and they were toddlers. I was visiting my mother's house, and we're going on a long trip. I had a rental car out front, and we're pulling it all together. And being on vacation, and this was many years ago, by the way, probably 2007, maybe. And I'm watching the market on my phone, and the S&P 500 hits my number, and I'm on the phone calling America from Kenyatta with this chaos going on. Where's the kids' socks? I don't freaking care where the socks are. I'm trying to, and of course, my idiot brokerage firm, they're like, we can't buy the S&P 500. I'm like, what the hell is wrong with you? But anyways, and it takes 3 days to get a trade in and all that kind of stuff. And I'm like, just freaking do something. This is the price I've been waiting for. And long story short, I wasn't able to catch it. So I've been burned by reality before. This is why I'm rushing back from Cuba, because next week, to me, in my books, is the greatest week of the year, potentially. And so I'm worried that it's going to start 2 days early without me. So, anyways, I might be looking at some of these assets as buying opportunities, and I'll show you. I'll show you later. Euro dollar below 109. Let me remind you of the history of the last 3 weeks. 110, 109, 110, 109, 110, 109, 110, 109, 108, 80. Huh. Bitcoin was stuck around 30,000. Remember, I was holding it at 29.3. I think I had a Bitcoin. And I'm like, yeah, no. Went to cash and this thing dropped. And I'm like, oh, those feel so much better than wins. Avoiding losses for me is the type of trade that brings me most joy. Picking a winner is like the job. It's the point. I'm like, yeah, I know I bought it. It went up. Like, why would I be joyous about that? Nobody likes losses, but avoiding a bullet, oh my God, that feels so good when it comes down to you needed discipline to carry out that action and then paid off. Feels really good. All right. So, anyways, that's where we are now. Take a look at the risk gauges. Just looking out a little further. Yeah, we went way, way risk off. Way, way risk off. This, like a week ago, was a zero. It's way risk off. Now, when you analyze the S&P 500, like VIX is up, S&P 500 down, dollar strong, and that yield on the 10-year just bonkers. Okay. So VIX way up, yields way up. Okay. Very, very, very bearish week. Luckily, we were set neutral to bearish. Thank goodness. But now I'm thinking, when do we buy the dip? Okay. Remember, I'm not trying to pick a bottom. So if I buy a dip, if I have a logical reason to buy a dip today or next week, it doesn't have to be the bottom. If it makes a lower low in September, that's cool. I'm willing to break even for a good opportunity to the upside. I'm not trying to be perfect, but I am trying to make money. So you kind of have to be in the game. Okay. All right. Scatter plot. Scatter plot. Scatter plot. Okay, so where are we? Bitcoin way down. That makes me so happy. That could have been me run over by the bus, the Bitcoin bus. Uh, okay, cool. Get rid of that. Let's zoom in a little bit more. NASI way down makes sense. Remember, I said that was going to be the biggest loser out of all the different stock indices in the United States of America. And we talked about it right at the end of July. Nikkei's down, which makes sense. So that could bring some yen strength, although we haven't seen it lately, but it might just show up out of the blue. S&P 500 way down. Okay, remember all of this is what we've discussed. Remember, bearish expected. Okay, like this is all right as rain. Oil way up now. Oil dropped to what, 78? And now it's back to kind of 80. And I told you yesterday I'm interested in buying a dip, so this might be setting up. So I might look for a little fib retracement, double bottom kind of thing. But I got a moving average in my face, so we can talk about that later. Yeah, and everything else, nothing. So stock indices down, oil up. Do you recall talking about I had a theory that oil going up would be the thing that brings the stock market down? It's kind of interesting to see all the stock markets down and oil up, and nothing else really matters. Anyone can see. Okay, so dollar pairs, yen pairs, all flat relative to these moves. Cool, interesting. I want to look at the yield on the 10-year T note here. Just crazy bullish. And check it out. Normal, 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 normal. Now the rate is cray cray. But look at QuantBox. It's like, yeah, it's very bullish. Thank you, QuantBox. So I actually want this to come back down. I'm not benefiting from the up. I am exposed to the long end of the yield curve. In fact, I'm on 20-year bonds, treasuries, technically, the 20-year T note. Now, why is that? Well, the 20-year, well, let's just do basic undergrad stuff. Um, the 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 longer the date, meaning when you look at the yield curve, the 5-year, the 10-year, let's say 15-year, 20-year, 25-year, 30-year. Okay, the 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 farther out you go on that yield curve, the more sensitive to interest rate changes. So think about it this way. Let's say you own a 1-year government treasury and interest rates go up 25%. How much, not 25%, but 0.25%. The central bank raises or lowers interest rates. So over the course of a year, how much money do you actually lose? It's actually not that much, right? The value of that bond won't change that much over a year. You're like, well, I was expected to be paid, you know, 4, but interest rates went up and it went to 4.25, so I lost value in my bond. Okay, great. But really, is it that much money? You only held it for a year, so you only lose like 0.25%, right? Well, what if it was 0.25 over 20 years? Every year you lose that. Well, now it's more and more and more and more. And it adds up. The absolute amount of money adds up because now it's every year. Okay. So they're more sensitive. So the 30 year is more sensitive to interest rate changes than the 20, and the 20 more sensitive than the 10, and so on and so forth. And the difference between the 1 year and 2 year, not a big deal, right? Because you're not holding it for very long. So there's not many periods of tiny losses. So, anywho, it looks like somewhere between now and the end of the year, it should recover. And it's the September to October period that it peaks, right? So, s- the theory here is my pain on the 20 year, because remember, up is not good. Um, Up in this case should peak pretty soon. And if I was going to hold it for 20 years, then who even cares, right? So, anyways, yep, yep, yep. Look at this, 70% short, and it's bullish. Oof. All right. So, anywho, just want to point that out. Very, very bullish. We're looking as high as 4.4 next week, 4.5. At some point, though, and it comes down to what you think the Fed's going to do in the near future, let's say over the next year or two. So the two concerns are, well, three, I guess. Is the Fed done? If they're not done, what is the terminal rate? And then if we're near the terminal rate, how long are they going to keep interest rates at that level, the terminal rate, until they normalize, which I think they're normal now. So, but the market's like, whoa, when is the Fed going to cut interest rates back to 2%? Never, but they're going to think about it and dwell on it, and all that kind of stuff impacts this yield. But at some point, they'll say, well, if inflation does go back to 2%, either because of the Fed or because of a recession, maybe if I was locked in at 4.5% for kind of like forever, you earn 4.5% for 10 years and then you get all your money back, you're like, you know what? That's actually a pretty good investment if inflation's going to be back down. What if you thought inflation wasn't coming back down? What if you thought we were at 4% inflation, structurally? Ooh, well, then you're going to need a higher yield if you're going to make that investment, right? Yeah. Remember, it will get interesting at some point. A couple of years ago, maybe let's say 3 years ago, I used to make a big stink about, investors with a 60/40 portfolio. I'm like, dude, if your financial advisors set up a 60/40 portfolio for you back after the 2008, they should be fired. Like complete negligence. Like it doesn't even make any sense. Well, if you can get if a 10 years paying not this. If it's paying yeah, if you yeah, I'll go back to this. If you can get a 5-year, 10-year T note. Okay, yeah. Yeah, 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 yeah. Now you can have part of your portfolio focused on bonds. You're going to collect this yield. You're going to hold to maturity. You're not going to trade bonds. You're going to invest money safely. And it's like a rainy day fund. That's the way you want to do it. But the stock market, because of what? Quantitative easing in 2008, the stock market's going up 15%, but also because of that same force, The Fed is buying buying bonds and driving down yields. Do you really want to own a 10-year T-note that paid 0.75? Probably not, right? This is going up 15% a year, and this is paying you nothing. You really want 40% of your portfolio locked in at nothing for 10 years? Really? That's the best investment advice you can get? Talk to Silicon Valley Bank. They had lots of 10-year T notes, right? So, anyways, but look, if you can lock in 5%. And so my point is, I don't want to use the fire analogy, but how about prices? The solution to high prices are high prices. You need to change your behavior, and that will change the high prices. You don't want the government to save you. Oh my God. So anyways, the solution to this problem, if you want to look at it, is if the 10-year T note goes to 5%, we're now at 4, on our way to 4.5. As we go to 5% and the rest of the market starts analyzing where they think future inflation rates are going to be, future interest rates are going to be, where the stock market's going to be in the future. If you're an institutional investor that needs 8% a year to survive as a museum or as a ballet for a local municipality, could you have part of your portfolio because you want low volatility and you want to as close to guarantee income as possible? Would you buy a 10-year T note at 5%? Yeah, you probably would. It's not enough, but it's stable. Would you buy a 10-year T note at 0.75? I hope not. So, anyways, the higher this goes, the more likely somebody's going to buy it if they think inflation's going to be lower that in the future. If you think inflation's going back to 8%, then this 5% is not enough. The bond market will continue to fall. See, you have to understand, as these yields go up, it tells you nobody's buying bonds. Well, why wouldn't they buy a bond if it was a safe investment? It's not attractive enough. It's weird to have the bond market crashing and the stock market falling, right? That's why you wouldn't want a 60/40. It's not right. It's correlated right now. Okay. Remember also about a month ago, I gave you a training on 10-year T note, and I said, who's selling? Let's go back one more. Why is this falling? Well, maybe demand is low because 5% or 4.25 is not quite enough. That might be true. But what about the supply side of the equation? Well, the Treasury is issuing $1 trillion right now, $1 trillion worth of new treasuries. This is because we had a debt ceiling problem. This is where the media just drops everything and we move on to the next thing. What's Trump going to say today? Well, the big news is, like, remember that whole debt ceiling people cared about? Well, now we're paying the penalty for that. So the Treasury is dumping $1 trillion worth of treasuries. That lowers the price, raises the yield. It's crowding out. But who else is selling? The Fed through quantitative tightening. They're taking old bonds in this treasuries. They're taking old treasuries that were already issued years ago. They're sitting on the Fed's balance sheet. Recently, they've sold $750 billion. And the Treasury's dumped $1 trillion worth of new treasuries. That's like $2 trillion being sold. Yeah, bro, yield's going up. Yeah, makes sense, right? Cool. Now you know. All right, I want to do some quick technical analysis and then we get which ones do I want to do? Like pound was a doozy. We could do euro. I'm looking at it here. So euro, this is a take profit zone, green zone. Green means up. Okay. It's not the ultimate target, but it might be it for the week. And of course, I'm worried that boom, just a reversal comes out of nowhere because we're entering that time of year. Only a quant boxer would know. Okay. Interesting. A little hesitation. Look how far we are from the 21 EMA. If you remember my book, I said the farther from the 21 EMA, the more likely it wants to come back to the 200 EMA, or 20, in this case, 21, but ultimately it is the 200. And the analogy I give is pulling the string on a bow. The farther you pull on the bow, the more it wants to snap back. And so profit taking, maybe, but time of year, like, oh my God, this is so hard for me. This is so hard, right? Because I have to wait for markets to reverse, but I'm already planned. Like I'm ambushing here. So I want to be a little more early than usual. Here's what I want to show earlier. When I look at this on a smaller time frame, like 15, I mean, look at that. What if you thought it was going to do that before it did it, and now you see that? It's kind of hard to ignore, right? That would be indicative of risk on in the United States, dollar weakness, and money flowing to Great Britain for those future interest rate hikes that haven't happened yet. Okay. So this is difficult. So, like, here's a plan that's planned out. Is this valid? Yes. Uh, Could it be the last hurrah? Yes. So here's a plan for the week. I think it's a weekly plan. We hit it. Okay. We hit it. Look at the target. Beautiful. So technically, if you believe the trend is going to continue down, yeah, you got a plan like the one I've already put together. Uh, but I need to be aware that it could be in the next 2 days, it could be in the next 6 weeks. Something like this starts to form, and eventually a reversal, not just a retracement, but a reversal. Doesn't exist on this chart. How many times have you heard me say that over the years? It doesn't exist on this chart yet. Nothing on this chart says that. But we can think further out, and don't be shocked if it's in a week or in 4 weeks that something like this then develops. At what point will you see it if it happens? Well, if you can't draw it now, you're not going to see it later. Okay. You're going to see what you want to see, or what you don't want to see is what your mind is going to paint. I don't know how your mind works. For some of us, you see all the things you don't want to see. Other people, you see all the things you want to see. What our challenge as traders and investors, our challenge is to see reality. And it's not easy because we're filled with biases. So you have to constantly shape your bias instead of just getting the same bias. It's kind of like spending half the day watching Fox and the other half watching CNN. Okay. I'm out on Walden Pond, I think. Yeah, sorry, too early. That's Thoreau, isn't it? Yeah, too early for Thoreau. Yeah, well, we all have our scarlet letters. Oh no, he won't stop. All right, here we go. Um, there's that pullback. So I was talking about this earlier. I'm very interested in oil. I have been as it's been falling. It's falling. That's great. Remember yesterday, get ready for a big oil day. Yep, there's a big oil day. Great, great, great. Yeah. 79. Okay. Um, we are very close. We are very, very close. So I'm looking at resistance I've drawn. I mean, old resistance becoming support. This is the buy zone. Okay, previously, right, that we've known for 2 weeks. It's not perfect. There's going to be a price if the narrative is that there's no recession and that things will work out. Things will work out okay. Remember that 3 weeks ago, that was the entire world's opinion. Everything's okay. There's no recession. The stock market's going up. Problem solved. Remember, this was 3 weeks ago. And I said, get ready, because seasonality tells us that that narrative is going to be completely different soon, and you're going to hear nothing but bad news. Anybody remember all that 3 weeks ago? And I'm like, "Oh, in 3 weeks, everything's going to be bad. Zombie apocalypse again." And it might be true. We don't actually know. But here we are, and everything sounds terrible. Well, if this swings back to the other narrative of like recession averted, okay, oil's going up. So it sounds like a stinker now because it dropped from 85 to 79. That's a huge drop. So what's your future narrative? The future narrative could be, nope, things are not as bad. There won't be a recession. Everything's fine. If there is a recession, it'll be mild, but the world is recovering. Everything's great. Then oil will go up. Or you can say we're going to get hit by a massive inflation. Okay, well, when you get hit by massive inflation, gold goes up, right? Yeah. When inflation's going up, you want to own gold. People bought it after inflation. Well, that's dumb. But if you think inflation's going to go back up, you would want to own gold. And well, you want to own anything real. Okay. Anything real. Okay. Gold, real estate. A barrel of oil is a barrel of oil. It's not a synthetic manufactured esoteric invisible thing. No, there's a barrel and there's some crude, and it took humanity's greatest minds and hardest workers to get that for you. There's going to be value to it. Okay. You want to own those things in that scenario. What do you not want to own? Well, apparently a 10-year T note. Okay. Apparently not the stock market. Food prices will probably go up. There'll be inflation, and you'll want to spend money on food. I'm pretty sure of it. Even if there's not much money to go around, you're probably going to spend money on food. Shotgun sales are probably going to go up, and the price of a shotgun will probably go up if there's extreme inflation. Okay. Yeah. Yeah. Cool. Because, right, you want to get rid of the other way of looking at it is cash is trash. If it's invisible value, it doesn't work out well during high times of periods of high inflation. Okay. If you can't buy a new car because the loan is 9% or 10%, then you're going to buy a used car, right? We've been through that. Used car prices go back up. How can I get that data? It's released every month. So anyways, as we watch that data, we have to get smart. Let me get one last thing for you to read on the fundamentals side. Are we going into recession? Is inflation under control? This is what we're trying to figure out. I'm waiting for the Atlanta Fed to load. All right, well, let me click it again. Atlanta Fed. Come on, Atlanta Fed. I must. Okay. So Bostic sits on the board of overseers at Harvard. Nice. GDP now. I think the Atlanta Fed's goofy. I don't know if it's Bostic, but I think they've been goofy for a while. So you get almost like, I don't know, it sounds terrible if I said politically motivated economics, but then that makes me sound very Fox Newsworthy. I'm not trying to be that way. So I sometimes question the methodology of analysis, let's say. I don't know. I would do slightly different math. So when you look at the Atlanta Fed's estimates, I don't necessarily agree with them, but it's a Fed. What can I say? They're going to interpret their data the way they say, and they could be right. So it's just one of the many institutions. So you're supposed to read all of the different stuff, right? But anyways, you could look at what they're going to show you here, and I don't want to do it. I don't want to. Well, maybe we can do it now. Well, uh, they're trying to predict GDP into the future, and so you can go through and check out this report. I'll leave you the link. I'll take you to the site instead of the presentation, and you can spend some time here. But they're trying to help you predict the future. Okay. Let me just you're like, wait, what's he talking about? See, look, they're trying to predict the future. Okay. So you can put that feather in your cap and call it macaroni. That's one piece of information about the future. And so if you were talking to a potential investor into your hedge fund, you could talk about many different things to show how smart you are and what kind of research you do. And you can say, well, this morning, right? The Atlanta Fed released their GDP now, and they estimate GDP growth as blah 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 blah, and that helps you enter that into your model, and that helps you make wise investment decisions now based on future expectations of things like growth of the economy. And in my macroeconomics course, which every subscriber to QuantBox has, you can review that. And I tie in productivity and growth as like the most important thing. I tie it to dignity and self-worth. So it might help you make wise investment decisions. It's the Atlanta Fed. So personally, what I do, and it's just my point of view, I look at what they project and I cut it back a little bit. I don't have to agree, but it is a piece of data that I can utilize. So anyways, there you go. I put it in the link, atlantafed.org, Fed Now. Okay. Or GDP Now tool. Cool. So I will leave you there. Oh, Mark says, don't we need China to turn oil prices around? Yeah. Yeah. Where's my thing? Yeah, for sure, eh? Let's move this around. Yeah, that it's not the only thing. And we kind of want to know normal, and the price of oil is coming down, and we're entering an up period. And then if you believe, let's say, the analysis of the Atlanta Fed, okay, Mark, if you're like, you read that, you see their projections, and you're like, well, that would be future demand growth in the United States for United States oil and Canadian oil. So you could have part of your model, Mark, would be the narrative of the Atlanta Fed says says this, and based on that information, you project demand here, and based on the demand here in the future, you think the price of oil will go up and down. Whatever you decide, then you look at seasonality. And what if you thought up, but it said seasonality down? Well, then you're going to wait quite a bit, huh? And then what if you thought up and seasonally that makes a ton of sense? Then you're probably going to be buying dips. Okay. And when in doubt, okay, set up the next round, set up the next wave. Retail doesn't know what's going on here. Okay. Look at this. Retail doesn't know what's going on. They're long and short. They're just getting run over. But institutional investors, 75.5% are long. And we're running into a 2-month bullish period. And I might have an opinion, like the Atlanta Fed, that maybe there's up in the future. And so what we're looking at here, the next 6 months could look like, oil was at 86, now it's down. And then it could kind of look like this for the next few months. Well, then I want to buy. And then, of course, along the way, if I buy and make money, one of the things that'll happen is that China will do some sort of stimulus, and people will say, "Oh, that means demand for oil," and then but I'm already in. Okay, I'm already in, and it'll be part of the narrative that works, and you'll say, "Oh, that was such a good trade, and now everything's going your way." Yeah, I need to get there first. Cool, right? So, anyways, yeah. So, what we know about volume and volatility is that this is typically the slowest period of time, and that in the near future, it will rise. Volume and volatility will rise. So, this time of year, you need to figure out what your narrative is for between now and the end of the year. Are you a bull or are you a bear? Otherwise, you will not know what to do. And you're like a retail trader on oil. You're half the time long, half the time short. Okay. And there are a lot of smart people on Wall Street that seem to have made a decision. 75.5% are long. Isn't it nice to know that, though? By the way, again, if you're starting a hedge fund and you're meeting with potential investors, and you're like, well, did you know 75.5% of institutional investors are long oil right now? Yeah. And the week over week change in futures contracts on that, and you're like, whoa, 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 whoa. And the Fed, Atlanta Fed's GDP now, and you're getting all excited, like, I'm geeking out on all this. I have an opinion on the markets. I'm trying to accurately predict the future every day. So I have research to help me do that. And the technical analysis is just me entering and exiting trades at the right price at the right time. But the rationale and reason comes from logic and intelligence through research. Oh, and then you can tell your investor that you're so smart. Instead of hiring a whole bunch of quants for $280,000 a year, you pay $80 a month at QuantBox. Nice. Or less if you're an annual subscriber. They're like, you're very smart. I think I will give you my money to manage. Yeah, that's how you woo. So, anyways, peace on earth. May the pips be with you. May your profits be above average. I will not be here tomorrow. I will not be here Monday. I am out doing macroeconomic research. Okay, out in the field. Yeah, doing research. Cool. So, tomorrow, about what time is it? Tomorrow afternoon, I am meeting with the former head of the foreign exchange department of the country of Cuba. He will, well, obviously, the foreign exchange desk is part of the economics wing of their government. And so I can also talk economics with this guy. Cuba is crushed right now with inflation. They are doing many different strategies. They're even trying to get rid of cash, paper money, because they're finding that there's just too much money. Nobody puts it in a bank. Everybody's hoarding it under their bed. They don't even know, I would imagine, they don't even know how much cash there is. So they're trying to wean people off cash and be able to control the money supply by digitizing everything. Ooh, this is interesting stuff. Oh my God. So what how do you make these decisions and what goes into it and what are the concerns? And isn't it cool be able to sit down? Yeah, should be very interesting. And of course, you can live that through me. So you're there with me and I'll say, this question is from Jean Guy. Yeah, and I'll ask, and I'll bring these stories back, and it's ours because we have a community. So thank you for being part of the community. Peace on earth, may the pips be with you. See you Tuesday. May your profits be above average. Ciao. Beep.